Good afternoon and welcome to this week's edition of Halftime Talk. We're delighted to be back in the US again with a special guest from Houston, Texas, Abhi Rajendran, head of global oil downstream markets, North America energy research at Energy Intelligence. Although Abhi's based and lives in New York, he is in Texas. On the road again, Abhi. Welcome to the show.
Thanks for having me, Sean. It's nice to be on the road.
Well, let's say you're on the road, you're closer to the Permian Basin than probably Manhattan is. What's the latest? There does seem to be a last week. I mean, I don't know, that was the first time I remember in a long time that we saw a double-digit increase in rig counts added to the U.S. oil production. What's your latest sort of call on the recovery of U.S. oil?
Yeah, no, I'll just highlight a couple of things. It's interesting. This is my third trip down to Houston in the last 6 months, and certainly the mood has started getting brighter and brighter, right? I think higher oil prices, now higher natural gas prices, and then broader energy prices is definitely kind of uplifting the mood in the industry and in town here. Having said that, I think there's still kind of a hesitancy, in terms of kind of reactivating capital expenditures, putting money back into the drill bit too quickly. I think that is certainly still, the mantra that the industry is living by here. Companies are still sort of under the lens of investors, who are looking for strong returns, strong cash flows, capital discipline. These are all themes that have been percolating for many years now, right? And we're sort of turbocharged by the pandemic downturn.
I mean, we're seeing this again, record profits in the majors, and the complaint seems to be that at least on the political side, that they're giving too much of the money back to shareholders and dividends and share buybacks, and not putting enough of it into the ground.
Exactly, and this is kind of the three-way debate that we're having now, right? Now, companies, especially public companies, they answer to shareholders, right? Shareholders are their bosses, and they're the ones that set management compensation. They're the ones who kind of guide company strategy, and all these points that I was making. We're prioritizing returns, strong cash flow generation, and cash flow returns, dividends, buybacks. That is still what companies are kind of mainly living to, especially the large public companies. And so, so you have, on the other hand, you have the kind of the political call for more drilling, more oil, more gas production. But companies are still saying, hey, look, if we change course now, we're going to have investors, punish us, by selling our stock, by pushing back on us. And that is still, kind of, who we are answering to at the moment. So, to your question on a kind of recovery in production, we still think it's going to be pretty gradual this year. We only estimate, about a, kind of a 800,000 barrel a day recovery in oil supply this year, which I think puts us on the low end of what's expected. Some expect, including the EIA here in the US, expect closer to 1 million barrel a day oil supply recovery. We still think it's going to be, on the more slower side, despite the rig count pickup and kind of the pickup in activity that you cited. We think supply recovery is going to be slow. Plus, you also have bottlenecks and supply chain issues to deal with.
Well, it's interesting on the bigger sort of frame there of who's your most important stakeholder. It's kind of ironic in some ways that Joe Biden has become the biggest salesman for U.S. hydrocarbons out in the world, basically trying to convince everybody stop buying Russian and buy whatever else is available. Whatever else is available happens to be American to a certain extent. Is there an awareness growing in the U.S. oil production, gas production in particular, seems to be a bit more alert to the opportunity that this is a major structural realignment in global energy flows, and if Texas doesn't get up to scratch, they're going to miss the boat.
Yeah, no, I mean, this is certainly kind of the dilemma, right, that the administration has found itself in. For the time being, they're sort of traveling around the world looking for whatever available supply there is today. The answer is there's very little. I think there's some spare capacity in your home base in the UAE and in Saudi. That's about it though. And even that is fairly minimal, and even Middle Eastern supply will take time to reactivate as investments pick up in the region. And so over the short term, this is kind of why the U.S. administration has pushed ahead with this big SPR release. There's very little spare supply out there in the world, and so you have to basically pull on inventories when you have an outage like what the Russia situation is causing. But looking a little bit more medium term, I mean, certainly as you pointed out, I mean that's exactly right. There's kind of a reordering of the global energy, at least supply side, kind of traditional order, right? Where the dislocation of Russia, both for oil and for gas, is going to have knock-on effects for a long time. It's a huge opportunity for the U.S. and the question is kind of how we capitalize on it, how we take advantage of it. I think there's definitely as you pointed out, gas, LNG. We have an opportunity to directly assist our allies in Europe here. On the oil side, it's a little bit dicier, right, because of climate and emissions and other goals. But even on the oil side, there's there's room for oil growth, which, as you pointed out, the administration is kind of more actively talking about. But there's still a lot of kind of other talk from the government too, right? There's still kind of this climate emissions, energy transition side that is effectively suppressing the ability for companies to kind of more freely, open up the taps or at least ramp up CapEx.
Well, I mean, as you said earlier, they've got to answer to their shareholders. Increasingly, their shareholders are also advocating an awareness to the green agenda. Let's just look a little bit beyond Texas and the US patch and think more, let's say Mexico, Brazil, even Venezuela. Obviously, there was some talks there. What's the outlook? Let's start with Venezuela, given that that's the biggest untapped reserve in the world. Not untapped, but practically.
Yeah, I mean, Venezuela has obviously, gone through a lot of troubles for many years now. I mean, and what's interesting, you started to see some initial signs of the administration even trying to, see if we can get some additional investment going in Venezuela. We think Venezuela is going to take a long time to recover. So the outlook there is, for at least the next couple of years is maybe moderately better than being on this path of flat to declining production. Maybe there's some opportunity for modest growth, but again, it's very small, kind of in the context of what the world needs. And I would say even kind of Mexico has faced many challenges, financial and other, and is not sort of ready to really ramp up. But I think Latin America is different. I think Latin America is a little bit of a different story. Brazil, and then you have kind of your new stories in Guyana. Maybe over time Suriname will join it. Potentially Argentina. So I think there are opportunities, and even companies, countries like Colombia, have started to kind of balance both the transition to longer term goals, but also the opportunities for a ramp up in supply over the next couple of years. So as Russia and others are sort of backed out of at least kind of Western flows, right, with all the self-sanctioning, I think there's opportunities both here in Texas, especially. Permian Basin, a key one, but also in Latin America. Central America, I think, will be a little bit tougher. It'll be a little bit of a longer road.
Ironically, they're caught. It's always been a puzzle to me how Washington hasn't sort of found a pathway to coexist in a very economically productive way with Central America. It just seems like the ultimate own goal of lost opportunity, but we won't solve that today. Let's talk a little bit more immediate term on the downstream side in the US. We could have a very peculiar situation in the second quarter here with no maintenance season. US refiners seem to be ramping it up big time.
Yeah, I mean, look, like, we did lose some refining capacity during the downturn, right? Closed or converted capacity. And so, but domestic demand is extremely strong for now, right? And you're going into driving season, your diesel, distillate demand, jet fuel demand, all of it is quite strong. And so, refiners are incentivized to run as hard as they can. And if you look,
typically you would see them take something going offline for a bit of maintenance, switch over to gasoline. That doesn't seem to be on the cards. What's the ramifications if indeed they don't go through a maintenance season?
Yeah, I mean, but I think the kind of the cracks and you look at the pricing, the product pricing, for diesels, for gasoline, even though it's come off to some degree. It's still extremely supportive, right? And for them to kind of just crank through with a pretty shallow or light maintenance season across the system. The demand is there. The profit margin indicators are there. So they're going to sort of plow through. It's a great environment for U.S. refiners, right? Strong product pricing, even with high oil prices, the cracks are pretty strong.
After a difficult few years, they're going to make hay when the sun shines.
Exactly, and again, kind of like everything else in energy, even on the downstream refining side, we're sort of short on supply, right? So we're limited in terms of any kind of new capacity or spare capacity that can come on and really sort of mess up the margin environment. So it's a pretty strong backdrop for at least the domestic refining system.
What about on the LNG side? Again, we would typically expect the winter ending that the gas would soften, but this could be a season where LNG plows right through the whole summer as everybody, loads up every inventory box they have in anticipation of next winter.
Yeah, exactly. I mean, basically, you have Europe and Asia, sort of leaning on U.S. LNG, right, to meet their demand needs and to fill up as much storage as possible. I mean, just in the case of Europe, I mean, they've announced plans for switching of Russian gas, right, a pretty aggressive one over the course of this year, and getting as much U.S. LNG and in some cases outbidding Japan for U.S. LNG will be a big part of it. So effectively, you have kind of the domestic gas system here, catering to domestic demand, but also increasingly kind of in the strains of this demand pull from Europe and Asia. That's why you have $6+ natural gas prices here. This is typically shoulder season. This is the time when you have a little bit of softness in pricing. Instead, pricing has just gone straight up. Domestic demand is strong. Industrial demand and demand here is strong. You've had coal to gas switching because you've had limitations on coal capacity. All of it is a strong setup for natural gas too. And again, it's another factor that should, in a normal environment, stimulate more domestic supply, right? It'll certainly help around the Gulf Coast. But to your point, I mean, there's definitely an opportunity for U.S. LNG over time. But the Permian can't solve it all, right? It can't be just the Permian. But we've also put, again, all these kind of pipeline constraints and all these environmental issues that make it harder to get gas, for example, from the Northeast down to the Gulf Coast, to help add more supply. And for that matter, one thing we haven't talked about is Canada, right? Keystone XL, that is, again, a big pipeline bottleneck that'll prevent.
Is there any chance that could come back on the agenda?
It's not looking like it's on the cards over the near term, right? And again, the Keystone XL is like the symbol of the climate and emissions, and it's kind of this this taboo that the Biden administration, from a pure market perspective now, especially as you're replacing Russian crude, it makes sense to boost Canadian oil production for domestic use, and again to send to our allies in Europe and other parts of the world. But you need that pipe. And
well, let's just leap across then to our allies, our customers. Allies is a nice word for customers when one's got a big dollar sign on the price tag, but nonetheless, customer allies. The outlook for Russia, it seems to be the big unknown. We've seen oil prices drop 4% this week, rise 4% this week. The market looks like it's looking for direction, and the direction is hidden in a box that says Russian oil disruption, but nobody knows the number.
Yeah, it's very messy, right? I think there's three kind of main factors in the market, right? One, again, like you said, the Russian oil dislocation, which I'll touch on in a sec. Two is kind of the SPR offset, right? That is supply that is definitely kind of coming harder and harder from the U.S. and other IEA members to kind of offset that. And then there's the demand impact, right? We think there's basically no question that the large parts of Europe are going to go into some sort of a recession, milder in Western Europe, more severe in Eastern Europe, Russian recession also. But the question is how deep and for how long. So there's also a demand offset that kind of counterbalances the Russian kind of oil dislocation. And on that, our numbers are like so far in April, we've seen March was like exports kind of continuing as normal, but storage filling up domestically, storage filling up overseas. Again, opportunistic buying from India, China, etc. But we've already started to see about 400,000 or 500,000 barrels of a supply impact, kind of backing up on Russia. We think that number will at least double. So we're kind of thinking, that'll grow to at least 1 million barrels a day, maybe, but probably will be limited to, kind of 1 million to 1.5 million barrel a day. A lot of the kind of the self-sanctioning and dislocated crude will be rediverted to China, to India, to other sources, especially with deep discounts. But again, we're kind of, limiting our supply dislocation again to kind of that 1 plus 1 to 1.5 million barrel a day range over the next several months, which again, SPR's demand impact can probably kind of manage, right? So, the market will be a little bit messy, a little bit sort of disoriented and tight. It was already a tight market pre-war, and you have a uplift in demand, in other parts of the world, seasonally.
And
so,
you have
we
the
think
unknown with China, right? China demand destruction. We've got something like 40 odd cities around China in some form of lockdown, I mean, representing close to 40% of the Chinese economy. I mean, this is a big challenge at the moment in China. And with it, obviously, it goes energy consumption with no mobility happening.
That's exactly right. And that's why, sort of the market is kind of eased off this like 120, 30, 40, $50 case for now. But, again, with all these kind of demand spurts as we've seen, or these sputters as we've seen over the last couple of years in COVID, these do tend to come back within a month or two. And so we still think, we're in for kind of $100+ environment, going into the summer. We're thinking kind of closer to low hundreds. And again, the SPR, the demand offset, will limit your upside, right? And so that's kind of how we're thinking about it. But
on the technical end of the SPR release, particularly the American, given it's so big, how immediate is that in terms of that oil meeting the market? I mean, it's averaged out by analysis as, that's equal to 1 million barrels a day, but it's not like there's a pump that pumps out 1 million barrels a day. Technically, how quick does that oil get to the market?
The SPR is already releasing 500,000 barrels a day. That's today. That was last week already. So we're already half. Remember, there was already a prior SPR release announcement before the recent one, right? So
yes,
the SPRs have already been releasing for some time, and we're already doing over 500,000 barrels a day now. And so we expect that to again ramp up. Again, I think there's some logistical questions on whether the U.S. can actually do a full 1 million barrels a day for a prolonged period of time. But the SPR will come. I mean, it's already coming, and that supply will come. There's questions around the grades and the match to the domestic refining system, and whether some of that will end up getting exported to India or Europe or other parts. But the SPRs are going to come. I mean, that volume is already coming, which again will help cool off that upside.
Where does OPEC now in all of this, do you think? OPEC plus, obviously Russia, the big actor inside the OPEC plus kitchen, Saudi Arabia, but ultimately they're caught on this sort of, we're increasing 400 a day every month when they're not even getting that. Where's OPEC in this market? How relevant are they? Where is it going forward? Everybody keeps calling on them to pump more. They keep saying no, but ultimately they don't appear to have it.
Yeah, I mean, I think you hit on a couple of the main points. I think, look, if they were to pump more, if they were to meaningfully add more supply, it would effectively mean Saudi Arabia and the UAE sort of stepping outside the bounds of the OPEC plus agreement, right? Which they're not willing to do. They're not willing to sort of mess around with the cohesiveness that they've built up over the last couple of years. And so that little extra spare capacity that is there, they're not going to do it. I think they too are sort of in watch and wait mode, right? Trying to quantify the magnitude of the Russian dislocation, how big and for how long. What happens with the U.S.-Iran negotiations, even though that's sort of on ice for the moment. And then what happens to the macro demand environment too. And
what happens when this agreement expires and ends in September? I mean, ultimately, that's like 5 minutes away.
Exactly. And so for now, they're not really incentivized to do anything different. And again, it's really only sort of 2 countries that have the capacity to do much different. And and they're not going to sort of rock the boat internally too much. And one of the points you made, I mean, I think I think it's sort of overblown how much OPEC plus can really do, right, in this kind of market environment. And so for them, kind of prioritizing the group's alignment and cohesiveness is it makes sense for them to focus on that for the moment.
outlook for the politics of everything at the moment. We have elections everywhere, or not everywhere, but in a lot of places. Obviously, the French election is a big one, given how tight it has become. We have the outlook for the US elections, the midterm elections in a few months' time. How do they think they inform some of the policy decisions that may impact energy demand?
Yeah, I mean, I think that's a question we can have like a whole another hour conversation about. But you look, I mean, I think there, especially Western countries across Europe, and you mentioned France and of course Germany and other places, and the US, and Canada for that matter, have been kind of trying to sort of push this long-term transition, kind of climate-centric narrative, right? But in the process of sort of messed up the short term, and of course the Russia Ukraine conflict has exacerbated that. But they're all the political systems, especially the ones going through election cycles, are dealing with the short-term inflation, shortage, outage, high, and it's inflation across the board. It's certainly with regard to energy, but then energy is like such a core part of the economy. It filters through to everything else, right? Metals, mining, food, agricultural products, by way of ag. It's a tough backdrop.
Can the Fed spoil this party, quote unquote, for hydrocarbons this summer? I mean, if we go into a very extra kind of tightening, accelerated tightening.
And that is the other part of it, right? Like, you are already in like a global tightening cycle, and we don't see how the Fed can kind of back off this, kind of chasing this inflation over the short term. Because again, we don't think it's going away quickly, even though maybe you cap the upside. The core inflation is still going to be pretty strong, and it's going to again take a while to be felt in different parts of the chain. So the Fed is going to have to chase it. I don't know about spoiling the party, but again, it just makes that demand environment tougher. Also, which again, limits the upside. So very tricky macro backdrop for sure.
Very tricky macro backdrop. We'll have to leave it there. Thank you, Abhi. Rajendran, Head of Global Oil Downstream Markets, North America Energy Research at Energy Intelligence. Thank you for your time and joining us on Halftime Talk this week.
Sean, thanks for having me. Talk to you soon.
Pleasure.